Trump's tariffs are accidentally making the rest of the world rich. That headline might sound like clickbait, but the numbers are screaming it from every trading floor on the planet. On the morning of August 8, 2025, global investors woke up to a reality that would have been unthinkable just 3 years ago. International stock markets are now beating the once unstoppable S&P 500 at its own game. And brace yourself, Donald Trump's trade taxes are the unlikely rocket fuel. But here's where it gets controversial. The very policy designed to protect American industry is, in real time, shifting trillions of dollars of wealth overseas. If you're holding a plain vanilla U.S. index fund, you're watching the tide roll out. If you're diversified abroad, you're surfing a wave most people didn't even see coming. Let's unpack why. 1. The fear factor flips when the White House slapped fresh tariffs on everything from European EVs to Asian semiconductors. Wall Street's first instinct was panic. Analysts dusted off their 2018 playbooks and warned of higher costs, squeezed margins, and slower earnings growth for U.S. multinationals. That fear alone was enough to cool the jets of the S&P 500, which had spent the last decade acting like it had a permanent, first-class ticket to the moon. Meanwhile, international companies, especially those with limited U.S. exposure, suddenly looked like safe havens. European luxury brands, they sell mostly to Chinese and Middle Eastern shoppers. Japanese robotics firms, their biggest clients are in Southeast Asia. Latin American commodity giants, they're feeding global supply chains that now bypass U.S. ports. In other words, the tariffs created a reverse contagion. Risk was quarantined inside American borders, and the rest of the world got a halo. Currency wins at their backs. Every tariff headline pushed the U.S. dollar a little higher at first. A stronger greenback makes American exports pricier and foreign profits worth less when converted back to dollars. But the dollar's surge also made everything outside the U.S. cheaper for global investors. A European stock that looked pricey at 100 euros suddenly felt like a bargain at 90 euros once the euro dipped. The same math played out from Seoul to Sao Paulo. Currency-adjusted returns for non-U.S. markets started to look downright heroic. 3. Earnings growth goes global. Corporate America has spent years squeezing extra profit out of buybacks and tax cuts. Overseas firms, by contrast, still have room to grow by simply selling more stuff. When tariffs nudged global supply chains to reroute around the United States, those foreign companies captured market share almost overnight. German chemical producers, Korean battery makers, and Indian software houses all posted double-digit earnings surprises in the first half of 2025. The S&P 500? Flat at best. 4. The first time since 2009, but with a twist. International markets last beat the S&P 500 in 2022, but that was during a brutal bear market when everything was falling, and foreign stocks simply fell less. This time, we're in a rising market. And international equities are not just falling slower, they're actually sprinting ahead. The last time that happened was 2009, when the world was clawing its way out of the global financial crisis. Back then, emerging markets led the charge. Today, it's a broader coalition. Europe, Japan, parts of Asia, and even frontier markets like Vietnam and Poland are all flashing green on the scoreboard. 5. What this means for your portfolio. If you're a beginner, think of it like this. Imagine 2 lemonade stands on the same street. One stand, the U.S., just raised prices because lemons got more expensive. The other stands, international markets, kept prices steady and started attracting all the thirsty customers. Over time, the second group sells more cups, earns more tips, and becomes the new neighborhood favorite. Your job as an investor is to own a piece of every stand so you never miss the next crowd favorite. Translation: a simple 60-40 U.S. international split might not cut it anymore. Some advisors are now tilting 50-50 or even 45-55 in favor of non-U.S. equities. Exchange-traded funds like the Vanguard FTSE All-World ex-US VEU or the iShares MSCI ACWI ex-US have quietly become the cool kids in the ETF cafeteria. 6. The elephant in the room. Is this sustainable? Critics argue that tariffs could just as easily be reversed with a single executive order, sending money flooding back into U.S. markets. Others say the outperformance is a sugar high driven by currency swings, not real economic strength. And this is the part most people miss. If the U.S. consumer, still the 800-pound gorilla of global demand, starts to pull back, even the best international companies could see sales evaporate. But here's the counter-controversy. What if tariffs aren't a temporary blip? What if they're the new normal in a multipolar world where supply chains deliberately avoid any one dominant economy? If that's the case, the current rotation away from U.S. megacaps could last not for months, but for years. 7. Your move, investor. So are you cheering for the global comeback? Or do you think Uncle Sam will reclaim the throne once the tariff noise dies down? Drop your hot take below. Are you doubling down on international ETFs? Or are you bargain hunting beaten up U.S. names? And here's a spicy question to light up the comment section. If tariffs are so bad for America, why are they so good for literally everyone else? Let's hear it. Agree, disagree, or roast me in real time. The floor is yours.